As of this morning, a new round of tariffs has officially gone into effect. This follows Trump's Liberation Day when tariffs were first announced, and the markets began to react. Now, since the February highs, the markets pulled back nearly 20%, much of this tied to uncertainty over how far these measures will go. In the days leading up to this moment, some were still expecting a delay or possible compromise. We even saw fake news post earlier this week claiming a last-minute delay, sparking a brief rally in the markets, but that was later debunked, sending markets plunging. The question is, are these tariffs setting up for new opportunities to trade, and are they going to trigger another wave of market volatility? Stick around, because at the end of the video, I want to break down what stock is showing the best seasonal setup right now and which sectors are already holding up best in this environment. So let's get started. Hey there, Tom Gentile here. Welcome to my trading room. If you're new to the channel, I'm not a meme trader. I'm a pattern trader. And today, I want to do a deep dive into the recent tariff news and, of course, the patterns that are happening right now, regardless of the outcome. Now, when tariffs come back in the spotlight, it's only a matter of time before comparisons start. And sure enough, some folks are already pointing to the Smoot-Hawley Act of 1930 as a cautionary tale. That law contributed to a 65% collapse in global trade during the Great Depression. But this is a very different world we live in. We've got diversified sourcing, global logistics, and supply chains that are way more adaptive than they were back in 1930. The latest round of reciprocal tariffs spans more than 90 countries now. That's a sweeping move with global implications. But one country stands above the rest, and you know who I'm thinking of: China. It's not just about trade imbalances. China has been the most aggressive in retaliating, and that's drawn the harshest response. Trump has now imposed a 104% tariff on all Chinese goods, meaning U.S. trade with China could be on the verge of collapsing. But we've already been moving in that direction. China's share of U.S. imports has been steadily shrinking since 2018, when Trump first kicked off a trade war. And we're now seeing an acceleration of that trend. For some context, one estimate out of Yale found that even a theoretical 60% tariff on China could reduce trade by nearly 80%. So what's a 104% rate going to do? It's likely to cut even deeper. Bottom line, this isn't just a headline. It's a structural shift. So what's really going on here? Here's what I think. It isn't just about leveling the playing field with 90 plus countries. When you look at the sheer size of the tariffs on China and how aggressively they've been singled out, it starts to look like the reciprocal tariffs are really aimed at pressuring China. And the way it's being rolled out, well, looks a lot like the classic art of the deal move. Come in hard, create pressure, and then use that pressure as leverage to strike better agreements. We've seen this approach before. Trump has suggested that countries lining up to make the trade deals more behind the scenes, and just recently, Elon Musk has already floated the idea of a zero tariff-free trade zone with the EU. Now, that doesn't point to long-term isolationism. It actually might signal a push toward a freer, more balanced trade, especially among U.S. allies. In other words, the tariffs may not be the end game. They may be the opening move. So now that tariffs are officially in place, the real question is, how long do they stay before deals start coming together? Let me give you a couple scenarios of what we see. Scenario A would be if a trade war escalates. That means tariffs stay high or even increase, and more countries retaliate. Winners would be U.S. industries like steel, aluminum, and textiles. North American manufacturers are also winners, and near-shore suppliers, this becomes a win-win for them. Losers, imports like Apple, Target, Best Buy, they're going to see pressure on their margins. Consumers will face higher prices on everything from tools to TVs, and global supply chains are going to deal with delays and as well as rising costs. Now, scenario B looks like this: a global de-escalation either with or without China. The U.S. would form tighter trade ties with partners like India, Vietnam, Mexico, and the EU. The winners would be logistics firms diversified supply chains, and U.S.-aligned exporters. Also, companies in the U.S. that are already operating outside of China, and sectors like energy, agriculture, and pharma would get new access. Losers would be companies that are still heavily reliant on Chinese manufacturing. China would lose share and influence in U.S.-centered trade networks. And of course, smaller firms, slow to diversify. We'll see many of those. Those could also see margin strain. So no matter how this plays out, companies are not waiting. Apple, for instance, Walmart, and others are moving production to India, Vietnam, and Mexico. This is a trend known as the China Plus One strategy. Take Apple, for example. Analysts are estimating that 32% of iPhone production could move to India by 2027. But a full decoupling, it's not going to happen overnight. China still holds key advantages, like over 80% of the world's rare earth processing and 20% of all electronics exports. Those are critical for everything from EVs to magnets, defense systems, and smartphones. So where can we look for strength right now? My money counter has highlighted several stocks that held up well despite the recent volatility, particularly in healthcare and consumer staples. So we're talking about names like United Healthcare, Kroger, and Humana. These companies are not heavily exposed to international supply chains, and they provide essential services that hold up well in uncertain markets. Historically, these defensive names are also considered safe havens, especially under the broader market when it's under stress. So these stocks tend to follow strong seasonal patterns. And of those, the top performer since Liberation Day with the strongest seasonal pattern, and it's a 90% historical win rate over the past 10 years, is United Healthcare. Now, as you can see from the table, UNH has had a history of going up between now and summer, with 2022 as the only loser. And while there are no guarantees in trading, I love the way this pattern's looking now. To wrap it up, tariffs have to be credible, and now that they're being enforced, the market's treating them that way. Also, a freer trade future still looks like the goal, even with most of the world if China's left out. And finally, earnings risk. Although it's very real in the short term, especially companies that can't adapt, longer term looks better. Now that the initial shocks played out, and if progress continues in most countries, it's hard to see things getting much worse from here. And as Treasury Secretary Scott Bennett said, today's tariffs will be a ceiling, not a floor. That assumes no further escalation. Now, looking ahead, earnings season may bring more volatility as many companies are going to choose to hold back their forward guidance while uncertainty remains high. And one thing we're watching very closely is the upcoming earnings for the Mag 7, who often set a tone for the broader market. Now, as far as Mag 7 concerned, check out my earlier video this week where I do a deep dive on the discounts that you can get on Mag 7 stocks right now. We interrupt this broadcast with a major update. Here we go in real time. I turned around and I'm looking at the markets, and Trump just announced a 90-day pause in tariffs. But wait, there's more. China's tariff just jumped to 125%, so it's looking more and more like scenario B is starting to play out. We're going to see seesawing back and forth in the markets from day to day, and I know these headlines can feel overwhelming, but this isn't the first time the markets face big policy shifts or global uncertainty. So the key here, folks, is to stay focused, stay selective, and lean on what works. And for me, that's seasonality, pattern setups, and smart risk management. Let me know what you're watching in the comments below. And if you found this helpful, hit that like button and subscribe, and I'll see you on the next video.